Hi folks, and welcome to this video on contingencies. A contingency by definition is a material event, meaning that it's important and financially significant and that it's very costly and it has an uncertain future. So that sounds like a very big definition in the sense that what does it mean? But if you look at an example of one, like a lawsuit, it might become clearer. Because we all know that if a company is trying to settle a lawsuit, it can be very material because it can be costly, and it has an uncertain future because we need a future event, like a court case, to determine what the outcome is going to be. So, if we use this as an example, we know that we could either win our case if we are suing somebody, and if we do win, there's a gain for us. There's a windfall of money. We would consider that a gain. If we're the defendant in a case, there's a chance that we may lose, meaning that we have to pay something out. So contingent gains or contingent losses can occur for a company depending on whether they're the ones suing, which means it might be a contingent gain, or they're the ones being sued, which means they may have a loss because they may need to pay out. From an accounting perspective, the question becomes, how do we record them on the financial statements? If we have contingent gains and they're contingent on this outcome of the court case, gains are never quantified in the financial statements, meaning that we do not make a journal entry to quantify what we think the gain might be. The only thing we do is we disclose them in the notes. It's a more conservative approach, and under IFRS and ASPE, this is what's recommended and followed. Now let's say that we are being sued, and there is a possibility that we may lose. The way we handle contingent losses differs under IFRS and ASPE. Under International Financial Reporting Standards, or IFRS, if it's probable that you'll pay out, and probable means a likelihood in excess of 50% that you'll pay, that means we need to set up a liability. That means you have to do a debit and a credit and set it up in the financial statements. Under ASPE, Accounting Standards for Private Enterprises, the standard is a bit more relaxed. Only if it's significantly or highly likely, significantly in excess of 50%. So what do we mean by significantly? Well, the company would have to define that for us. Is it 80%? Is it 90%? They would have to define that. All right, but whatever that significant percentage in excess of 50% is, only at that point, when it hits that highest level of likelihood, would we have to set up a liability in terms of quantifying it in the statements. So we can see under IFRS, you're more apt to disclose a contingent loss because the chances of it being at least 50% that you might need to pay out is easier to meet than meeting a standard that has to be significantly in excess of 50%. So you can see here under IFRS, more companies would be setting up a liability and quantifying it in their statements than they may under ASPE. But in either case, we do always do a note disclosure under IFRS and ASPE to explain what the lawsuit is about, to explain if there's a lower bound and an upper bound of what we think we might pay out. If companies don't feel comfortable disclosing that because they don't want to tip their hand to the competition or, to the lawyers for the opposition party there, we might just say what we think the likelihood is of payment. And we, say we don't think we'll pay it out, or we don't think it will be anywhere near what's estimated, or something of that nature. But we do disclose the type of situation that we're facing. We give it, some description as to what the lawsuit might be and what it's for. So this concludes our short lecture on contingencies. We will study more of this topic whereby we make entries and we calculate how much to quantify in the financial statements in our next course in financial accounting.